I've spent the last 18 years investing, buying, selling, talking about, writing about, and on occasion dreaming about property. In other words, I have a slightly biased opinion on the matter. But I know property investing isn't for everyone. And it's better to understand that up front rather than to put in all the work, buy a property, and then realize you hate it 6 months down the line. So let's run through who shouldn't invest in property versus who should. And I'll also give you a few alternative options to property for those who decide it's not the right move. So who shouldn't? Well, the first reason to give property a miss is if you're just not interested. I mean, now that sounds really obvious, but it's worth being clear that property isn't just like any other investment. In the early stages, you need to put in the time to learn what it's all about, really understand how it works. And that's because the nature of property is that it's chunky. You can't subdivide it. So you're always making a big commitment of cash when you make a single investment. It's not like with the stock market where you could put £50 in and just see how it goes. So that means you really need to put in the time up front to understand what returns are you likely to get. How do mortgages work? What's the tax situation? How should you be set up? How does managing property work? Should you do it yourself or use a managing agent? There's so much to think about. And for a lot of people, that is fun. There will be people who are watching channels like this as semi-entertainment. Yes, it's about making money, but it's also something they really enjoy. And if that's you, that's a really great sign that property might be for you. But if you're already feeling your eyes glazing over as I go through that list, yeah, it could just be me. But it might also be a sign that property just doesn't do it for you. And that's fine. There are other things you can invest in. Now, there might be people who you know who haven't done that, who haven't put in all the time and done the research. They've just spotted a property on the next street that's up for sale. They had some cash, they bought it, all good. They've done really, really well. Does that negate the point? Not really, because the world of property really has changed beyond recognition over the last decade. It used to be the case that you could just own a property on the side. There was the phenomenon of the dinner party landlord, people who like to brag about their buy-to-lets, but they really weren't serious about it in any way. Now, though, there's much more complexity, much more legislation. In many respects, that's not a bad thing, but it does mean that if you want to get into property, you need to put in the time to educate yourself up front, and that means it's got to be something you enjoy, or it's just going to be torture. Linked to that, I'm also not convinced it's worth going into property unless you have the ambition to scale beyond just one or two. And that doesn't mean you have to be going out and buying a load of properties on day one. Hardly anyone can afford to buy more than one to start with. But I feel like you've got to have at least the ambition and see some kind of path to owning more than one or two properties eventually. And that's because, like I said, it involves more setup than investing in other assets. So it needs to be worth it. Now, I don't mean to scare you off with all this talk about how much time is involved in property. If you're just doing normal buy-to-let, so you're buying a property and renting it out, most of the time there isn't going to be anything to do at all. It's not going to take over your life. But there are also both upfront and ongoing costs that make more sense when you have multiple properties. For example, many investors now prefer to invest within a company for various tax reasons that we've covered in other videos. To come to that decision, you'll often want to take some kind of tax advice. That's a cost. And then if you do decide to invest via a company, there are costs associated with running that company and producing the annual accounts. And the cost is going to be roughly the same whether you've got one property or five. Now, this is not a hard and fast rule. If you want to just own one property for diversification reasons or whatever, but it's something you enjoy and you want to put the time in, then absolutely all good. I just think you'll get the most out of property if you do have that ambition to eventually scale over time. That's not a hard and fast rule, but this one is. You should not be investing in property if you have a low tolerance for things going wrong. Things will go wrong with every property at some point. It just happens. You can't avoid it. You could make the best investment in the world. You could do all the greatest research. You could be ultra cautious. Things are still going to happen. Now, admittedly, I've had my biggest headaches when I haven't been so careful and when I've been a bit silly. That's what's led to incidents like the police breaking down the front door of one of my properties twice. But you're also going to get random leaks. You're going to get a tenant who you've done everything you possibly could in terms of referencing, but they stop paying the rent or they fall behind. Things are going to happen. Most of the time, it's not a big deal. If you've been careful, if you've got an emergency fund, it's not going to make or break your investment. And over the 10 plus years that you end up owning the property, you're not even going to notice it. You're not going to remember it in even a year's time. But it can become a big deal in your mind while it's happening. Some people just have a higher tolerance for this stuff than others. Some people are more inclined to get worked up, take things personally, or whatever. And to a degree, it is a tolerance that you build up over time. And the first time something happens, it's always scarier and it seems less of a big deal the next time it happens. But I think it's worth being aware of how you are and just imagining for a moment that something has happened, really putting yourself in it and going, would that bother me or not? Because even if property is the greatest financial investment you could ever make for your situation, if it's going to stress you out, it's not worth it. Another reason to stay away from property is if you're scared of debt or you just can't get comfortable with debt, because in my opinion, it's the debt that makes it worthwhile. If you look at the returns of property versus any other asset class like the stock market, there's not much to choose between them. At times, one is doing better, at times the other is doing better. But when you use a mortgage, again, over the long term, property tends to win by an absolute mile. And that's because, quite simply, if you're putting down a 25% deposit and that's it, then you're able to buy 4 times more property with the same money. And that's 4 times as much property that has the potential to go up in value. So it's really not a fair fight. Of course, property wins. In reality, there's taxes and other costs. That means it's not quite 4 to 1, but you get the general idea. Now, most people are intrinsically uncomfortable with the idea of debt. I was when I started. But if you can become comfortable with it, about using debt as a tool, which you've covered in other videos, then I just see it as such a big advantage, and property without leverage is just so much less appealing. Another reason to potentially avoid property is if your motivation for investing is to make extra income today. That might sound strange because you'll rent the property out, you'll pay your mortgage, you'll pay all your costs, and you'll have £200 left over. And surely that's £200 extra that you can use to improve your life today. But the reason that it doesn't quite work out that way is tax. Tax on property works differently from tax on anything else. And we've got another video explaining how this all works. But the gist of it is, if you own property personally and you're a higher rate taxpayer, then you will pay an enormous amount of tax on your property profits. If you own the property within a company, not a problem. The tax treatment is much better. But if you then take the money out of the company to spend personally, while you are still a higher rate taxpayer from your job, let's say, then you'll pay a huge amount of tax at the point of taking it out. So either way, it doesn't really work. Of course, you will have access to that cash in the end. You can let it build up in the company over time to pay for the deposit on the next one, or you can withdraw it yourself when your earned income has gone away and so your tax rate is lower, or you can pass the whole lot on. There's a lot you can do, but taking the money today just doesn't really work. So if that's your objective, there are probably routes other than property that are more suited to making that happen. That's who shouldn't invest in property, but who should? Well, it's kind of just the flip of what we've already covered, but you do see property working particularly well in certain situations. The first is if you have a long time frame. I've often said before that the thing that really makes you money in property is time, because a single year in property, even a good year, is not going to be that exciting. I know a lot of people who buy their first property, be super excited about it, but then almost feel disappointed and let down after a year. They go, well, this hasn't really changed my life in any way. But that's because property and most other things aren't going to change your life over a single year. But the more time you've got, the more powerful it is. Let's say, for example, that you put £100,000 into property. Now, because you've used mortgages, that means you might be multiplying the annual growth in the value of your property by 3 or 4, because you've only put in a third or a quarter of the money. And of course, you're collecting your rental income on top. So even if you've only got average annual growth of, say, 3-4% per year, that could equate to a 12% return on the cash that you've put in. Now, over a single year, that's £12,000. Fine. Over 10 years, it's more than £300,000, which is a lot better. But over 20 years, it's nearly £1 million because of that compounding effect over time. Now, 12% might not be the right number. It might be way too high, or it might not be ambitious enough. It depends on your investing style. But the point is, the longer you invest for, the more beneficial that leveraged growth is. And the implication of that is the longer you're investing for, the less hard you need to work, because time is going to be doing the work for you. Property is also great if you want to build something to pass on. If you structure that property in a company, then there are ways of passing that on over time. Of course, you can pass on other assets as well, but I've just seen this from working with so many of our clients. People feel differently about passing on a collection of properties than they do about passing on a portfolio of shares or something that will just be liquidated to get the cash. It feels very different, and a lot of people I see get their kids involved in the property business as well, and they use that as a way of educating them about money. It's something they really enjoy. Another situation that I see work really well for a lot of our clients is if they've already got a business, and that business can then lend money across to a business that invests in property. Now, a trading business doesn't have to mean a business that sells widgets. It can do, but it can also include people who freelance or consult through their own business. The reason this works so well is the tax position. Because you're not drawing the money out personally to invest with, there's less tax to pay. That means there's more money left over to invest with, which means more asset that can grow and compound over time. And overall, the people who should be investing in property are the ones who want to, because the best investment is one that you're excited about and you have confidence in. If you feel emotionally drawn and attracted to an investment, then you're far more likely to save up and make it happen. And it's also because if you really believe in it as an asset, then you're less likely to be rattled when those things do go wrong, when there is some hassle, and you're far more likely to hold on and keep going rather than to sell out at what turns out to not be such a good time. Of course, the same can apply to other investments. People do get very excited about investing in the stock market. If that's you, that's great. That's what you should be doing. But if property is your thing, then you're probably in the right place. Now, if you are one of those people, you might disagree with me on this next statement, which is that there is more to life than property. I've been presenting a podcast about property for over a decade, but even for me, property isn't all I invest in. And there are some people who, like I said, for one of those reasons, property is just not going to be right for at all. So, of course, there are alternatives. And those alternatives do have a lot to recommend them, not least the tax position, because residential property that you own directly, you can't put into an ISA or a SIP, whereas many other types of investment you can. And anything that you have in an ISA or a SIP or some other kind of pension will grow tax-free. And of course, if you are investing in something other than property, you can get started in it without having to make that upfront commitment that I talked about. Of course, if you're going to be investing in individual stocks and putting a substantial amount of money into each of them, then of course you do need to be doing just as much research, if not more so. But to get started, you can just invest in index funds or whatever without knowing the first thing about how the stock market works. You can just go out and put £100 into a global tracker fund without having any opinions about what's likely to happen in the future, and congratulations, you are an investor. You have got started. Like I said though, some people are attracted to property because it is tangible, it's real, it's easy to understand. And if you're one of those people, but you're realizing that property might not be right for you, then lots of property investors also like gold. Gold has similarities with property, like it's got a long track record, it's physical, there's a fixed supply of it, and over the long term, it tends to be a hedge against inflation. And for that reason, the mentality of people who are drawn to gold can tend to be similar to people who are drawn to property. If property is for you, then it's great because it produces an income, which gold doesn't, and you can use leverage and get all those advantages. And of course, there's Bitcoin. I have to mention Bitcoin, otherwise I'll annoy a lot of people. But I'll also annoy a lot of people if I talk too much about Bitcoin, so I really can't win. The point is, there's a lot you can do. I've written books about this stuff. Ideally, you'll be doing a little bit of everything, making the most of the tax advantages of other investments, getting some diversification, but doing property too. But if you do have some money to invest, but you're still not quite sure what to do with it, then you might appreciate some investing advice from some of the richest people in the world. So check out this video next, where I break down how the super rich invest their money.